Good morning and welcome to the Great Transition Senior Living Series. We are happy to have you all with us, and we're going to talk about the time an attorney and an accountant walked into a bar, but today we're going to just walk into a bar with an accountant. So we've got a couple of changes in our seminar today, but I trust that you will find some great information. So I want to encourage you to take notes. If you have some questions while we're talking, jot those down so that you can remember them, because if you're like me, 5 minutes later, I'm like, I know I wanted to ask something, but I can't remember what it is. So jot that down, because we will have a little Q&A session at the end. Just a reminder that Great Transitions was founded in 2013 by Paul and Lynn Henderson. It was designed to help seniors during one of life's biggest transitions. Many people have been in their home for 20, 30, 40, maybe even 50 plus years, and making a move at that stage in life is really challenging. And so we know that it's a longer process, could be 12 to 18 months, could be even longer. And we're here to guide you through the entire process. We genuinely believe that guiding and helping older adults doing late in life moves is our calling, and we love being able to serve those that have served us so well for so long. Our objective here today is to give you an education. We want to, and every seminar, we're talking about legal, financial, housing, medical, all kinds of issues and topics of importance. It's a free seminar, and we're not here to sell you anything. It's just to provide information. We always do ask that you ask yourself a question, and that is, who is going to be tasked with making decisions for you when you are no longer able to do so, and will you agree with those decisions? We also want to make sure that as you're preparing your plan, that you've shared that with your all-star team, your board of directors, your trusted loved ones, whomever that is in your life, so that they know exactly what you want. So with that said, we're going to get going on our seminar today. And of course I have a little story to start out. So a pastor, an accountant, and an attorney walked into a bar to meet with a wealthy friend. And their wealthy friend began to tell them how hard he had worked for years and years and years and amassed this great fortune. And he had decided that he didn't want to leave it behind. He wanted to take it with him when he left. And so he charged them with each taking a third of his fortune, withdrawing that, and sneaking it into his coffin when he died. Well, they agreed to do that. Well, wouldn't you know, about a week later, the man died. And before long, after the funeral, the pastor, the accountant, and the attorney gathered together, and they were talking. And the pastor said, I have a confession to make. I took my portion and put it in the casket, but I actually withheld 10% to give to the poor. And the accountant said, well, I didn't follow his instructions exactly either. I put most of my portion in, but I kept 20% to cover all my fees and services. And the attorney stopped dead in his tracks, and he said, shame on both of you. I followed his instructions to the letter. I put a check for the full amount in his casket. So I hope Linda Solash-Reed gets to watch this video, because I was really prepping that story for her. In all seriousness, though, we were here to talk about wills and trusts and taxes, and all of that could be a semester-long course. So today we're mostly focusing on taxes and finances because Linda couldn't be with us today. We will take a a broad 30,000-foot view of some financial issues today. Understanding that we can't get too specific because we have a pretty broad audience. So we'll have a little Q&A at the end. We also encourage you to ask some questions, or if you want to have a consultation with one of our educational partners, if you've got financial questions or legal questions or whatever, on your surveys that you were given, just write us a little note that says, hi, I need to talk to an accountant, I need to talk to an attorney, I need to go tour a community, whatever it is that you would like to do next. Jot us a note, we read those. In fact, we meet after this seminar to go through all of those. So we will get you connected and get your questions answered. I think it was Benjamin Franklin that once said, in this world nothing can be said to be certain except death and taxes, 100%. And that's a certainty for each one of us, although I did hear somebody say that taxes were optional, I don't know. But the death part definitely isn't. So it's important for us to learn as much as we can. And so I want to introduce to you my good friend Pam Henley, who is an enrolled tax agent. She's the co-owner of, well, the owner.
I'm the owner.
Right, of All Florida Tax and Financial Solutions, which was started back in 2009. She graduated from Upper Iowa University and Allegheny College of Maryland. She's in her, are you still a council member in the city of Edgewood?
I'm a past council.
Okay, got that. Past member of the Orlando Ballet. And she received Tax Buzz Top 50 for tax professionals in the nation. So I think we got a good one here. We are going to just sit down at the bar and have a conversation about taxes. So we're really excited that you guys are going to join us today. All right, Pam, so let's get started.
All right.
And if you would, let's see.
Am I on?
You should be now.
Okay.
No?
Yes.
Yeah. Okay, there we go. So I introduced you as an enrolled tax agent. What's the difference between that and a CPA? I think CPA is the term most of us are familiar with.
Most of us are. And I like to think of it, the easy explanation is a CPA is like your general dentist. An enrolled agent is like going to, I hate to say it, a root canal specialist maybe. I specialize in tax. That's the main difference. As far as the courts are concerned and representation, we're all on the same playing field. So tax attorneys, CPAs, and enrolled agents can represent you in tax court.
Okay.
So that's pretty much the nutshell of it.
Well, we had a meeting yesterday, actually. I had a personal meeting with Pam to go over some tax stuff. And she explained it all very well because it was over my head. So thank you very much. So we talk a lot in our seminar series, and especially in our Downsizers Club, about documents and records. And I'm a paper person. I tend to keep a lot of stuff. But what do we really need to make sure that we're keeping? So if we're prepping for a move and maybe we're going from a 3,000 square foot house down to a 1,200 square foot apartment, we don't have as much room for all that stuff. So what are the important things?
So true. And I know that in the past when I've been at the seminars, everybody talks about the box, I call mine the hurricane box. And I keep all of my important documents in there, including my tax documents I have in there. So if you were ever in business prior to that, you want to keep any business documents, tax returns, receipts for 7 years. Okay? If you never owned a business and you've just been, yourself, W-2, 3 years. That's all you need is 3 years. The only time they say longer than that in the tax code is if there's fraud, and we know we don't do that. So 3 years.
Okay, so that's a lot less. And what do some of those documents look like? Are we saving bank statements, credit card statements, anything like that? What are the documents that we're saving?
If it's business related, yes. So you want to save all of your backup. And when I say save, at this day and age, we should be scanning. Scan
Okay.
those documents in. It's really the safest way a lot of times to keep your documents from being lost, especially when you're moving. Get a good, cloud storage, or put it on a separate. I tend to be a little over redundant for what I do. But I have my computer, I have my cloud, and then I have a hard drive, external hard drive, that I keep my documents on from just my business. I do the same with my personal, so that it's accessible. You don't have to box it all up if we're just scanning. And scanners are so reasonable now.
And if you didn't own a business and you were a W-2 employee, are you just keeping basically the tax returns for the 3 years?
Keep your tax returns, and you want to keep what made up the tax return. Okay, so you want to keep a copy of the W-2. If you have a portfolio, you want to keep your 1099-R, your composites, okay? Because that's what was reported to the IRS. So any document that was actually reported to the IRS is what we want to keep. Because, they have 3 years to make an adjustment on that return.
Okay.
And it's at the date of filing,
Okay.
which could be different. So, for example, right now, whether you know it or not, October 15th was personal extension, if you have one. Tax returns are due across the country, October 15th. In the state of Florida, depending on the county, and Orange County is one of them, we received an extension, and now ours is February. So in this case, if the person did the filing, their start date for 3 years, if they filed in February, would begin that February 2024.
Gotcha. And that would be for 2022 taxes?
2022 taxes.
Okay. Okay. All right. So every case is individual, but by and large, we're keeping tax returns, the backup behind them. 3 years?
3 years.
If you're not a business, 7 years if you had a business.
Correct. Let's have a drink.
Cheers. Yeah. Oh, I'm glad that happened. It's always good when those things happen. We talked about in one of our previous seminars, you mentioned the hurricane box. Many of you were here for the seminar with Heather and Diana when they talked about documents and how to manage those. We've also worked on our little binder, our Go binder at Downsizers Club, where I think it's nice when you can make that binder or that box with your stuff, but also have a copy binder that you can give to your all-star, your team, your board of directors, your trusted advisor, so that if it's, I'm going to the hospital, meet me there kind of thing, they can take the documents with you. I was talking to my parents about this the other day. My mother has everything very well organized, but I don't have the copies, and so I probably need to get those copies in a little binder just so I have them in there handy. So, okay, that is super helpful. We were going to have Linda go through the life documents that are needed, powers of attorney, deeds, wills, trusts, and all of those things. And so we're not really schooled in what's needed there, but you had an experience with a client I'd like for you to share with our people today about the importance of those documents, whatever they happen to look like for you.
Very important. Unfortunately, I had a client that they had a very unexpected death in the family, And they felt like they had everything in place with the estate, and it wasn't. From a tax standpoint, after someone passes, in this particular case, we prepared the tax return. The attorney had the trust all set up and ready to go. So those are two separate forms that we needed to file for the family. Where the sticky wick came into it was the power of attorney. And who was the trustee? And these are two things that you need to talk to your trusted attorney with who's helping you along. As long as the parent was alive at the time, the sibling or the child had power of attorney. Once they passed, they didn't have power of attorney any longer. So then and there was, when we prepared the tax return, there was a rather large refund due. So now the IRS wants to know, well, who is legally supposed to have this refund? And they want documentation. So where the issue became is they didn't have anything, a power of attorney in place after death, nor did they have it on a trust that who they wanted as the trustee was not sent paperwork saying that they were the representative of the trust. And this was paperwork that I need in order to finalize the tax return, put in the proper paperwork, show the IRS, hey, here's the representative of the estate per the trust, and they're due the refund. So it's taken us 6 months. We still haven't received our refund. And we've had to paper file it, which even slowed it down some more. So, it takes a lot, unfortunately, it's a lot of hoops that we're having to jump through to try to get back a refund, that if we had it all in place, it would have been an easy fix.
And I think a good attorney can help you decide what those what ifs might be in your specific situation. So, and I know that Linda, when she has talked to us before, a question is, how often do you update the documents? And I've heard her say whenever there's a change of some sort, you want to review the documents. They may need to be changed, they may not, right? But if it's, for me, for example, when my husband passed away, then the documents needed to be reviewed because they changed, right? So it's just staying on top of that, and it's the kind of thing that I know that I have put off doing it, because those aren't always the fun appointments that you make to say, when I'm gone, these are the things that I want to have happen. And yet, it's a big gift that you can give your family to not have to.
So true. So very true. Because they're struggling to get funds back that are rightfully theirs. And they'll get them. It's just not taking time.
Yeah. At a time when they're hurting already.
Exactly.
Yeah, not fun. Okay, well, let's talk a little bit about some tax stuff. Tax ramifications when selling a home after living there for a very long time. I think, raise your hand if you've lived in your home for more than 20 years. More than 30? Okay, more than 35? More than 40? Okay.
Wow.
Your parents have lived in their home how long, Teresa? 63 years. And they're still living independently.
She still doesn't inherit.
That's awesome. That's awesome. So my guess is the value of their home today is different when they bought it 63 years ago. So let's talk around that. Talk about tax ramifications after death. I think you kind of touched on that. And the documentation needed to document deductions for capital gains purposes. Because that word, capital gains, I think makes all of us a little bit nervous.
It does. It does, it really does, because it's a big tax hit that we want to try to avoid.
Okay.
So if you're selling a home and you've been in a home 20, 30 years, the IRS looks at it this way. It's called cost basis. So that means, what did you buy it for initially? Okay? Then they allow us some wiggle room on that cost basis. They want to know, over the years, what large improvements did you make to the home? Did you put a fence around it? Did you add a pool over the years? Hot water heaters, solar. These are kind of examples that would add to the value of the home.
What about a roof replacement?
A roof replacement, absolutely.
Plumbing?
Plumbing, you had to redo the plumbing. Renovation, I
Okay.
redid the kitchen. I renovated the entire home. I renovated a section. So keep those documents. If you want to, over the years, put those away, because when you go to sell the home, you're going to have it at a larger prices of homes just keep going up. The values of them keep going up. So your value is down here, and the value of what you sold it for is up here. So we want to try to close that gap, right? We are allowed primary home exclusion.
Okay.
So if you're single, you get to add to your cost basis $250,000. If you're married filing joint, you get to add $500,000 to your cost basis. So now we're getting closer,
Right.
because the idea is to walk out with zero. You don't want to pay any capital gains on your primary home. That's the goal. Does it always happen? No. But that's why keeping records of renovations, because we can add that to the cost basis. We can add solar to the cost basis. All of these large improvements that you've made on the home, we add those in, and then we subtract it from, what you actually purchased the home for to figure out if there's any gain.
So let me ask you about that. When, in real estate, when somebody says, well, I spent $25,000 updating my kitchen 10 years ago, that should add $25,000 to the value of the house. And we know that it does not, because you've enjoyed those renovations for that period of time. It might help the house sell faster because there are some newer things there, but it doesn't add a dollar for dollar value. On these deductions, if you spent $25,000, does that count as $25,000?
It does count as $25,000,
Okay.
because we're adding to what the initial cost of the home was.
Okay, so, and that would then reduce the tax burden.
Reduces the tax burden. So at the end of the day, it's going to be considered, if you did have a gain on it, it's going to be a long-term gain. So you're in a favorable tax bracket with it, and that's all going to depend on, your ordinary income rate and where you come in on that. For most long-term, most people are going to hit around no more than 20.
So going back to the documents that we need to keep, we need a folder for when now, if you bought a new appliance package and that's conveying with the house, is that considered an improvement?
If it's considered part of a renovation.
Okay.
Okay, so if you're redoing your kitchen, for example, and you're replacing the countertops, the cabinets, and you're getting new appliances, you're gonna lump all of those costs into one as the renovation or improvement.
Okay,
If my refrigerator just happens to go down, no,
gotcha.
okay?
But we're keeping all of those big improvements, and could be big and bigger improvements, I guess, right?
Correct.
Over the years in a folder. We don't need to keep it for a long time. Once we sell the house, we're done with that.
We're done.
But we need to have it for when we do sell the house.
Exactly, so that would be another one of those items that you'd want to scan in, because your tax professional is going to ask you for, when you purchase the house, let me see the HUD statement, right?
Right.
Your closing statement, because they're going to want to see what your cost basis was. Now, we can all go on to property appraisers and look back to see.
Right. So if you've lost your settlement
If you bought,
statement,
right, it's not the
that's
end of the
okay.
world,
Okay.
right? But the things that we do need to really try to have proof of are gonna be those larger improvements to add to the cost basis, because our job is to make sure that what we put on paper, we can back up.
Okay, okay, very cool. Okay, so let's shift gears a little bit. One of the topics that frequently comes up when we're looking at, especially when we're looking at maybe moving to a retirement community, downsizing to a retirement community, is long-term health care. So several people have a long-term health care policy. When do we start using that, I guess is a question. And do we ever cancel that policy?
The policy, long-term care, in my personal opinion, is just so worth having. It can save you so much money and your family's money by having it in place.
Okay.
It's, as you have the premium, it's tax deductible, right?
Okay, okay.
The policy itself is tax deductible. You put it on your Schedule A.
And we know as we age, it gets more and more expensive,
It
so
does.
if you have it, great. If you don't, it may not be something that you can implement at this point, just depending on the cost.
Exactly. Most long-term health insurance policies say that, and I'm not a specialist, so talk to your
Specialists are in the back of the
Right,
room.
there we go.
Sean and Dana will be the
Right.
ones to answer that question.
Right, but speak to them, they'll tell you the range of the age, like here's, when we say it's not feasible.
Okay, okay, but it's worth the ask, it sounds like.
It's definitely worth the ask. I personally have just done it. So,
Okay.
I, obviously a proponent of it, and it's worth it.
Okay, and I think Sean and Dana had shared in their seminar, that was back in January, that it does help to protect the portfolio when you have that in place. So a lot of the communities, I know several of the people in the room have toured with us when we did Village on the Green or Mayflower or Westminster. They'll say those are all entrance fee communities, life plan or life care. And you'll hear comments like a portion of your entrance fee may be tax deductible, a portion of your monthly may be tax deductible. I was talking with someone recently about that, and she said, well, we don't pay taxes right now as it is, so I don't think that would help us. What are your thoughts around that?
It really depends on the individual.
Okay.
There are people that have retirement plans in place, 1099Rs coming in, where they receive money monthly from their pension plans that they have. They have IRAs in place, so they have RMDs that are coming in that they have to, pull out of their IRAs.
Mm-hmm.
They have portfolios.
And an RMD?
Oh, yes. The required minimum distribution.
Just want to make sure we're all on the same page.
Sorry. So all of those things come into play. You have Social Security that may or may not be taxable depending on what your above the line income is.
Okay.
Okay? If you have gains from your non-qualified plans, those come into play. So there are other factors that can make this a deduction for the individual. And then there are some people that strictly, they don't have a need for a file.
If you had long-term care in place, would there ever be a time that you would cancel that policy?
I don't believe you would.
Okay. I wouldn't think so either, but I just wanted to ask a question.
No.
Okay, all right, very good. All right, so let's talk a little bit. We know that there's no inheritance tax here in Florida. We got some pretty nice benefits living in the great state of Florida, I think. But are there any instances where someone's beneficiaries might have to pay taxes on what they inherit?
Potentially. You know, and it depends on the size of the estate for the government.
Okay.
I do believe it's a little over before inheritance tax kicks in. I think for 2023, it's 12.9 million.
Okay.
Mhm. So if your state's
I'll
over
have
that.
to take a look and see if mine's getting
But most people don't. But you do have to remember, just to shift it just a tad, that you can do gifting. Don't forget about gifting.
prior to
Prior to
passing?
passing,
Okay.
gifting is a great idea to give to, you know, whoever you want. It's not just family specific. You can give to whomever.
An organization?
An organization, you can, 17,000, you know, per gift.
Okay.
That's, you know, not taxable,
17,000. Okay.
right? So like, I just had someone recently ask me, husband and wife, you know, so if you're married, your wife can give 17 and the husband can give 17 to the same individual.
Oh, okay. Gotcha. Not they can give it to each other.
No, not to each other.
Okay.
It's gonna go out the door.
Okay. Gotcha. But if they had a child or a friend that they want, that's then 34,000.
Right.
Okay. All right.
Makes it nice. It's a nice gift, tax-free.
Okay, and I think I've jumped ahead because we talked about tax deductions for assisted living. Well, let's take that a step further. So we talked about life care or life plan communities where there's an entrance fee, but what about a rental community? Do you have, and you're paying a monthly fee in a rental community that offers maybe independent assisted or memory care, or just assisted or memory care, portions of that might well be tax deductible?
Yes, they'll break that out for you. So if you have a portion of it where the community comes in and they help you with memory care, for instance, then the fees associated with the memory care assistance will become a deduction. Okay. The rental part of it, no.
Okay.
Okay, but it's the assisted part that you receive medically that can help you with your taxes.
If you're receiving care in the home?
Yes,
Okay.
absolutely.
All right. So as long as it's medical or necessary?
Medically necessary, right. So anytime, like if your Medicare tends to pay for it, or if there's something that's out of pocket that's your portion, and it's approved, that would be, your copay on it would be tax deductible in that sense.
Very good. So we touched briefly on selling a house that is a long-term, you know, you've lived in for a long time. A lot of, in our Downsizers Club, we talked about this last month. Sean and Dana gave us a great example. There are two questions that people often ask. Number one, can I afford to make a move at this stage in my life? And what if I run out of money, right?
Mm-hmm.
And so how can we financially facilitate a late-in-life move? What are some suggestions that you might have around that?
Well, obviously, you have a very huge asset in your home. So actually selling your home can then help fund, you know, a new community or home for you with assisted living. I would obviously, before doing any of that, you would want to, you know, partner with your financial advisors. Make sure you have a very good plan in place so that you know that it gives you peace of mind that everything that you're doing and the process that you're doing is going to meet your needs in the end. So, but yes, your home is a very, very huge asset to help you with that process.
And if you've documented it properly, you're gonna reduce the tax implications of that, protecting and preserving
Yes.
that. So, how should a financial advisor and an accountant work hand in glove, especially when we're looking at a late in life move? So you just said have your financial advisor look at what you've got, but how do you guys work together?
That's a great question. I work with financial advisors all the time.
Okay.
Because they have their piece of the puzzle that they're very good at. And then I have the tax side, which I know. And when you start partnering with your entire team, and even your attorney, you need to have the whole group involved in the conversation. Because sometimes I will see a piece of the puzzle that is my expertise. And, then it gives us time to figure it out and work around it and fix it
Okay.
for the tax implications.
So that sounds like a lot of coordination. Do you recommend starting with one over the other? Do you have a meeting with everybody in the same room?
No, actually, I'm in the process right now.
Okay.
I have a family. They have several businesses. They have assets in them, and then they're home, and they're working on their trust and estate planning.
Mm-hmm.
And their trust attorney put all of us in the same email.
Okay.
Okay, and we were moving some things around and reviewing it. I saw an issue, and it just happened to be on my side of it, where an asset is sitting in a particular entity that if it stays there, then there's going to be huge gains if they pass and the children sell it. So with the attorney, myself, financial planner, and now we've brought in a tax attorney, we're going to solve this so that in their future, they won't have a large gain on that asset. So that's just an example of how when you get everybody in the room, they see things differently.
Okay.
And it's easy in a simple email. You don't have to sit down because they had all of their estate planning ready to roll. Then they had their financial planner on board.
Right.
And then, we're all reviewing it together for their best interests. And, I just happened to see this one thing.
Yeah.
And it's going to save them, hundreds of thousands of dollars at the end of the day. So,
That's awesome.
yeah.
Yeah, that's really great.
So it's an easy process.
Okay. Okay. I read a book recently that talked about the IRS code, tax code, probably this big, right, is designed to help you pay less taxes. It's all the things you can do to pay less taxes. And it sounds like that's what you pretty much do, is find a way for us to...
We do. It's, if you have a passion, and I do, I think anyone in my field has a passion for what they do. As you all, in your lives, what your careers are, you have a passion for it. But that's the idea, is to basically find the law that helps you step outside the box, right?
Okay.
And to legally, hopefully, legally, everything's legal, to make sure that if you know something that you can, work the law into your advantage, right? Example, COVID's one of them. In COVID, there was a law that was put into place for self-employment individuals that a lot of people didn't know about. And it was worth $5,000 credit. So it's instances like that that if you keep up with it and you read and go to class and continue, yes, the government is out there to help us receive credits that we deserve.
So if somebody is contemplating they're obvious, people are in this room because they're contemplating, right? But they may say, I'm not ready yet, I'm probably 2 years out from making a move, I might be 5 years out from making a move. We know that circumstances can happen that will
Right.
shift gears and cause you to shift gears, which is why we talk about the importance of a plan. Can a tax professional help with that? So if I came to you and said, look, I know I'm going to be doing this in the next 2 to 5 years, do we need to be talking with our tax professional about that? And are there any particulars that we need to bring up?
I think you do, because you need to look, again, bring your team together. I know I keep saying that, but it's so important to bring the entire team together to look at because your financial planners know what your goals are and what your long-term plans are. Your tax accountant knows what the tax ramifications of those actions are.
Gotcha.
And then if we work together, then, we can try to, reduce your tax liability potentially over that period of time.
Okay, great. And I think it is super helpful to have somebody to bounce those things.
It's very helpful.
Maybe I'm considering this, I don't even know, so let's go down the path and see what it looks like.
Yeah.
So.
Especially when you get to retirement age and you start looking Social Security, how does that affect me, your spouse, if I lose my spouse, what happens to my Social Security benefits, right?
Right, oh yeah.
Right? All of that, can change on you.
Sure. Okay. Well, thank you.
Thank you.
Enlightened me with a lot of things, and I'm sure you guys got some good stuff. We do have some time for some questions, so our educational partners have the microphones. They're gonna come around, and you know what? Whoever has the microphone, I'm gonna ask you to come to the front of the room, because I think it's easier for you to see hands when they get raised up. So do we have any questions? Okay. All right, Kim, you wanna, or?
I always have questions. On the cost basis of selling the home, would closing costs at either end, or the realtor fees, would those be included in the cost basis?
They are.
So that's a great question.
That's a
So
very good question.
important to things that are included in those to raise that cost basis. Any closing costs on the buy side or the sell side?
Correct.
Okay. And any realtor fees that might be associated with that?
That is right.
Okay. Or if you have an attorney.
You are a deduction.
That's better than a kid.
Tell it, Joanne, tell
On the gifting, is it tax-free at both ends, the recipient and the giver?
Yes, ma'am.
it. So the question was, is gifting tax-free from the giver as well as the recipient? And so that's
It is. You just have to file a certain form with it, which is very straightforward. But yes.
Is there a gifting ceiling?
All right, hold on, we'll come to you in a minute. We got one back here. Wait a second, Kim, wait a second.
Is this one? Okay, I actually have two questions, but they're related. I wanted to go back to the discussion about building your team and just clarify, does it make sense to, if you're starting from scratch, to start with your financial advisor and build your team from there? And then also, the second part of my question is, I understand that you do a lot of tax work. If you get to the point where you need someone who's doing more day-to-day stuff for you, like paying your bills and that sort of thing, is that another person that needs to be on your team, like an accountant or whatever?
Okay, so just repeating the question, where do you start when you're building a team? And if you wanted more daily type of money management, where do you go there for information?
Right. So to build your team, I usually say, go to the individual professional that is your trusted professional. Start by, if you've had a tax professional for years and you have a very good relationship with them, then that might be a great start. and ask them, hey, I need, a financial advisor, who would you recommend? I recommend that you have get several names, sit down and meet with them. Make sure, because that's a relationship that you need to be sure that you're very comfortable with. And make that connection with that person and whoever institution or who you're working with, that you're very comfortable with them. Make sure that you bring the whole team together to work. As far as going to the next level of helping pay bills, those types of things, there's several options. Sometimes accounting firms will actually offer those options. There may be also outside of that, there may be bookkeepers, just strictly bookkeepers, that can help with actually paying the bills. So again, you could start with your trusted tax professional and kind of branch out from there. Or if you already have a financial advisor, then ask them, who do you work with that is your, an accountant that, you feel that would be a good fit for me.
I know we've talked previously, especially at Downsizers Club, I think about personal money managers.
Mm-hmm. Oh, very good.
Are you familiar?
Yeah.
Okay, well, there are people that actually, it would be like a bookkeeper
Okay.
that would manage your affairs for you. So there are resources to find them as well. And there are people in the room, specifically Pam, Dana, and Sean, that can help with finding people like that. So super important. All right, I think we had a question over here.
With the gifting, isn't there a ceiling on that?
It's 17,000.
I mean, a lifetime ceiling?
Oh, yes, there is.
Yeah, you just can't keep getting it
No,
away forever.
yes, and that's the whole reason for, filing the tax form to show what your giving is, because it does go against your lifetime estate.
Right. So the question that I had now comes back to the capital gains on the sale of your home with the 250, 500 deduction or limit or whatever you want to call that on that. It's like, I don't know how people in California live with that, but that's been that way for a long time. Is it ever going to get indexed up? I mean, with real estate prices
So will
going
that-
the way they are?
Will it increase? I don't hear anything in the pipeline. Things that I hear potentially that could change, which they have not as of yet. But the big change that they're talking about on the back end is the step up in basis and eliminating that.
What is the step up in basis?
So at time of passing, whoever inherits whatever assets you have, including stocks, your home, let's say your cost basis was 50,000 and the market price is 400, it automatically goes to the 400 to whoever is the beneficiary. So the potential is that at your passing, that property is worth 400,000. If they sell it at that particular time and it's level, yeah, they don't, you get zero capital gains. It does not apply.
Okay,
So that's the benefit of
Okay.
the step up basis. Same thing with your stocks, they get a step up as well.
okay.
So that is the main rumbling that I have heard.
And that could be positive change.
No, there would be a negative change because they're talking about taking it away.
Oh, gotcha.
So whatever you purchased your stocks at that time, that would pass to the inherited. They would not move up to the current value.
So that's something we probably want to keep our eye out for and maybe
We do.
call our legislator if it starts.
If we start hearing that rumbling, we definitely want to make sure as individuals that is not in our best interest at all.
So to follow up on that, if you have a capital gain, which the way real estate prices are going now, you may, does that go into the calculation of your income that hits the Medicare ratcheting up thing?
Unfortunately.
And how long does that go for? Can you appeal that, or how does that work?
I've had individuals try to appeal it. I personally don't know anybody who's been successful.
But that's fixed to you for
It's fixed.
several years,
It
right?
is, Yes.
Or does it ever go back? I don't
It does
even know.
go back down is my understanding, but it's an issue for sure because, you know, it's an anomaly, right?
Would you say that again in a sentence?
So clarify that a little bit more.
So what we're discussing is upon selling your home and Medicare is what we're talking about, and it can increase your Medicare costs.
If your home sells for a lot,
Sells for a lot and you end up with a gain, correct? So it'll affect your Medicare costs, is what we're talking about. And in my personal opinion, as we were discussing, it's usually a one-time big event, right? So to me, it's considered an anomaly, it shouldn't affect it, but that's not the way, you know, they see it. They say it's income, here's where your income has risen, so therefore you need to pay more in Medicare costs.
so all the more reason to keep that list of all the improvements to reduce that capital gains as much as possible.
Absolutely, absolutely.
Okay, very good. I think we have a question over here.
Raise their fee.
In regards to capital gains, now, if I bought my house for a certain amount, and then I put extras in it before we moved in, so does that allow for home improvement? Is that
Sure.
part of that?
The work was done prior to you actually residing in the home.
Yes. And also, if I live in a condo and I'm selling that and thinking about moving into a retirement center. For that, do you have to pay capital gains too if you're doing that?
So,
It's
So,
a sellable.
so the question is, if you're going into a retirement community, so you're not buying another home, which would negate your capital gains tax potentially, right? If you traded one primary residence for another?
no.
No, okay, all
But
right.
if you're using that money for
Yeah.
that, it's still.
Pardon me?
If you're using the money from the sale of the house to cover the entrance fee in a community, there's no correlation.
No, that's very, very old. You know, I get that question a lot.
Okay,
But the primary home, in order to receive the exclusion on the primary home, you had to have lived in it 2 of the 5 years.
okay, so most people have lived in their home 20 plus years.
Right, so,
Even 10
so
plus,
you're
you're fine.
definitely gonna get the exclusion on the home. Your question about it sounds like you renovated the home prior to taking, living in it, but it still is your primary home. So those renovations would count towards your cost basis on the home.
Okay.
Or the condo.
You said 2 to 5, I mean, I lived there for 17 years, so.
You're fine, you're covered.
So I don't have to pay any.
I don't know.
You know what we say, Joanne? It depends. It depends. That's the answer for a lot of things.
I don't know.
Do we have, Susan has a question, okay?
It may be maybe something I need to ask you just independent to myself, but I have a question on what part of memory care is taxable. Because my mom was in memory care, but she didn't have extra care there, but the whole time she was there, she was under nursing care, and everything that she had with her ADLs and her, medications and everything, being in a memory care facility was required nursing care. So what part of that is deductible? She didn't have add-on, but that whole part of it was nursing
Right.
care.
So typically, the IRS law states that if you have required nursing assistant, that it is required,
Right,
then it's a deduction.
okay.
So a portion of that monthly fee may be rent,
Correct.
and then a portion of it may be the care.
Right, but on the invoice, it only shows room and board.
Okay, so what I would do in your case is exactly, go back to, who's ever doing the billing and ask them to please break this out so that you can receive, the tax deduction on what portion is actually, nursing assistance. Because it is a deduction. And there is a portion in there that's gonna be what, the rent is gonna be for the community.
Okay.
Super
Thank you.
helpful. And that would apply to assisted living
Absolutely.
also.
Right,
Okay.
right,
Or skilled nursing.
right. That kind of baseline.
Love that. Okay, super helpful. Any other questions? Well, we've got another one. That's okay. That's okay.
That's over here, Clark.
Because the attorney wasn't here, we found ourselves with a little extra time.
Just to clarify what you were just saying, like skilled nursing, I thought that 100% of the cost was deductible because it's 24-hour nursing care and.
Skilled nursing,
Yeah,
yes.
they send you a 1099 at the end of the year for what you've paid, and the whole thing is deductible on your tax return.
For skilled nursing, you were absolutely correct.
Okay. And so
Yes.
memory care is different than that?
Well, so sometimes you're in a community with assisted living, and they will actually break out what portion of it is for rent, what portion is for memory care, what portion is.
So if you're in a community, like we know that Mayflower has skilled nursing and Westminster has skilled nursing, and you are a resident of the community and you have been upgraded to that,
Right.
is 100% of it or it's a portion?
I would think that you would have to contact the facility
Okay.
and talk to them and see how they are viewing,
Okay.
your
So it could be a
contract.
case-by-case basis.
Absolutely.
And some people would go straight into skilled nursing and not be a resident
Correct.
of the community, but just use the skilled nursing there.
Right.
So I think it
It
depends.
does depend. I would definitely, you'll need to look at, go to their accounts, billing and speak to them, see, how they're actually accounting for each portion of what you pay into the community. Because they should have a breakdown, whether it's 100% of it is totally skilled nursing, great, it's tax deductible. If, 10% of it is rent and 90% is skilled nursing, then there we go. Now we know what we can and cannot deduct, right? But if you're getting a 1099 of some sort for long-term care, I assume,
Right. Well, yeah, there's a 1099 for long-term care insurance.
right?
Of course, but and then there's not a 1099 for the monthly care that you pay to the facility.
I would definitely talk to the billing department and see what portion that they're counting for your deduction so that you know that you're on good footing on whatever you put on the return.
Does that help? Got one more question in the back there?
Yeah, I have a very basic question. So far now we have a lawyer, an accountant, and we have financial advisors. Then I've experienced that older couples, when they're transitioning from their Medicare, and we mentioned earlier Medicare changing if you sell your home, but I've experienced a person who helps people transition from their 90 days of Medicare into Medicaid. There's people out there who help you set their finances so that they get the most out of the benefits through the Medicare and the Medicaid system. Who is that?
Okay, so the question is Medicare and Medicaid, are there people that specialize in helping you get the most bang for your buck when you're having to make that transition?
So that's a process that you have to start at least 7 years back to get that in play for Social Security and Medicare. So if you're going to make, the state changes to protect, your assets and path that you're going to take is Medicare and Medicaid, then I know that the benchmark use are 7 years. So in that case, you want to be able to get with, I probably would start with my attorney, my estate planner. And get with them, let them know what your plan is, everything you have in play. The next person I would get involved would then be my financial planner, because the estate planner and the financial planner need to know exactly what each other are doing. The last person in this equation would be your accountant.
There are health insurance benefit advisors that can help, that are familiar with the various Medicare plans and then also familiar with Medicaid to help navigate what might be the best plan for you. So oftentimes financial advisors, CPAs, estate planning attorneys will connect you with a health insurance benefit advisor. And that's really their specialty.
So if I'm Googling, looking for this type of person, I would say
Health insurance benefits advisors.
Okay.
You can imagine that those people are very busy right now as we go into open enrollment. But just like they said, it's definitely in tandem with your tax professional, your financial advisor, and also your estate planning attorney.
And I think that's a great point, Dana, that talking to your trusted circle to expand it, getting those referrals, right? If they trust them, then, and I trust my financial advisor, and my financial advisor trusts this person, then I'm not left to Google reviews or whatever.
Right.
I think that's a place to start, but just keep it all in perspective.
We don't want anybody operating in a silo here. This is definitely not a place where you want to be a bobblehead and get passed from your person to your, blah, 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 blah. We want to operate as a team, your board of directors.
Awesome.
You need one quarterback, but you get to choose who that is.
Okay, very cool, very cool. I like that analogy. Thank you. All right, I think we have time for one more question. Joanne, did you have one more question?
Skilled nursing, that has to be in a facility, right, not home?
Skilled nursing?
No, you can have skilled nursing at home that's still tax deductible.
Really?
Yes, ma'am.
It's gonna be more expensive,
Oh, gosh, yes.
way more expensive than if you were at a community.
And it's probably a certain amount for deductions, maybe not very much.
For skilled nursing, no, where it would go on the tax return would be your Schedule A, and there is I call it a floor. So it's 7.5% of your adjusted gross income before you actually start to see the deduction. That's where it would hit.
Well, great questions, everybody. Did you learn anything today?
Yes.
I did too. Thank you so much.
Thank you for having me.
I was a little worried we weren't gonna be able to fill the time, but taxes are exciting.
Very. I think they are.
I think I have a newfound little area of interest. So we always ask you, did we try and sell you anything? All right, good. And then our charge is, what are you gonna do with the information that you received today? So our Downsizers Club gets homework every time they meet, and we encourage you to take a step forward in preparing your plan and getting your plan ready. Keep in mind that you're our connection to the world. A lot of you have come to our seminars through the newspaper, and we're really grateful for that. But the best invites are the ones that come from friends. So we encourage you to bring someone back with you to our next seminar. On the survey sheet, if you want to go ahead and get yourself pre-registered for the next seminar, you can just fill that out on the bottom of the survey. Our next seminar will be November 15th. Thank you. Is that the Ides of November? I don't think that's a thing. November 15th. And in anticipation of the holidays, our title is Providing Your Family with the Perfect Gift. So we're going to talk around that topic. It should be very interesting for you. We're going to close out with a quote today, and I think it's very appropriate given today's topic. Knowledge is power, and knowledge shared is power multiplied. And that was by Robert Boyce. So go forth knowing that you have been empowered with some good information and knowledge today, and use it to help put your plan together. Thanks so much for coming, and we'll see you next month.